Welcome to this Monday edition of Inside India. I'm Sri Jegarajah. Your headlines. President Trump says he will double tariffs on all steel imports. Indian steelmakers say they are on watch for any risk of trade diversion. India's fourth quarter GDP beats expectations, growing at its fastest pace in a year. We'll discuss what that could mean for the RBI decision later this week. And we are counting down to the debut of the Brookfield-backed Leela Hotel's $400 million IPO today, but it could be a muted start amid valuation concerns.
And IATA's 81st annual general meeting kicking off shortly, but we've already had a chance to sit down with Air India CEO Campbell Wilson. We'll be bringing that interview to you shortly.
Right, let's take a look at these Asian markets. And it is a risk-off start to the week across APAC. And President Trump said that he would double steel and aluminium tariffs on imports. And then, of course, we have this legal back and forth on reciprocal tariffs. So all of this seems to be pointing towards continued volatility and continued risks for the month of May. And do also remember, June. And do also remember we get May payrolls at the end of the week. So that's going to provide some food for thought in terms of where we are as far as the Fed is concerned. Now, turning towards the Indian markets, which join us in about 45 minutes' time, it looks like we're going to march to a very different drumbeat, considering the data that we got on Friday. Let's give you a glimpse of Gift Nifty futures, and they are teeing up an opening in the region of 24,845. So you're looking at a lift of about 100 points. And hardly unsurprising there, given the fact that we saw blow-away Q4 GDP numbers, 7.4%, surpassing expectations. We'll get onto that and deconstruct those numbers, what it means for the fiscal year in 2026 later on in the programme. The Trump tariff news cycle, meanwhile, is back with a vengeance, as the president decided to raise the current import tax on steel and aluminium from 25% to 50%. European Union has hit back, calling the move further uncertainty on the global economy, and has vowed to impose countermeasures on the United States. And Canada's steel industry has also called the new levy catastrophic. We will be live in Tokyo at 1:30 for more on this story. And Indian steelmakers are on alert for any potential trade diversion from US tariffs. Last week, we spoke with JSW Steel's CFO about the rising global tariff risk, and he told us that the safeguards they have had in place to counter dumping have been working.
The safeguard duties which are implemented have helped. We have seen prices improving towards March, also in April, which is something one should expect going into quarter one. We, JSW Steel, remain primarily a domestic producer. I mean, the capacity which we are creating is for India. The demand growth has been phenomenal, double-digit last 4 years in a row. So our focus primarily is India. We are not looking to, evaluate markets outside India. We do export, but that percentage also has come down over the last few quarters. Our focus is primarily India. We are building capacity for India, and we think there's going to be a market to absorb it.
Get back to the data. India's fourth quarter GDP rises faster than expectations, with an annual rate of 7.4% in the final quarter of the fiscal year. That equates to 6.5% gain for the full year, in line with estimates and the RBI's prediction, but still a significant drop in growth compared to recent years. And a reminder that we are working towards an RBI meeting later this week. Expectations are for another cut of 25 basis points at the policy meeting on June the 6th. Let's get more analysis on the GDP number. Bring in Anubhuti Sahay, head of India Economics Research at Standard Chartered Bank. Anubhuti, thank you very much indeed for joining me on Inside India. So how sustainable is this pace of growth in excess of 7% for future quarters? And when you lift the lid on the positive catalysts and what actually drove this economic activity in Q4, Just how sustainable are they? Are they looking like a one-hit wonder?
I would say that probably we will get another quarter where we might get a 7% number. Having said that, your question is extremely important. How sustainable is this? Getting a couple of quarters above 7% driven by statistical factor, better agricultural produce, which looks even buoyed when we are looking at the headline number, just because last year was extremely bad. These might not sustain going forward. So yes, is there a possibility that we might get another 7% GDP number? Yes. But if we are looking at a 4 quarters average, our full year forecast for next year is, that is FY26, is at 6.6%. The numbers were much higher than what any one of us expected. But the drivers, if we just scan through the details, one, there was a massive impact of like a statistical buoyancy given by the net indirect taxes growth. And that number can keep on fluctuating depending on when the subsidy payment happens. Construction turned out to be much better, which we think remains a strong point, but not as strong as it was in the last quarter of fiscal year 25. So these factors would fade away, and then India, in our view, will come back towards the trend growth of 6.5%. Consumption still remains K-shaped. Private investment is not likely to come back anytime soon, and that makes 6.5% more likely than a 7% number.
I understand. So what about for FY26, Anubhuti? Can we afford perhaps to nudge our forecasts for the next fiscal higher?
We have actually nudged our forecast slightly higher. We were previously expecting 6.5%. We upgraded it only marginally to 6.6%. So it's primarily because the momentum was very strong in the March quarter, that some spillover in the June quarter is very likely. Having said that, as I highlighted, quarterly averages can be extremely volatile. Just to remind ourselves, in the September quarter, there was this whole pessimism about Indian economic growth outlook because the GDP number was less than 6%. And now there is a lot of optimism. We have to look at the underlyings. And as I mentioned, consumption is looking better, but it won't be firing the way it was before the pandemic. Private investment is unlikely to come forth, especially given the heightened external sector uncertainties. Public capex would continue, but the drivers of economy, whether we talk about rural demand, some counter-cyclical policy measures by the government and the RBI, and the public capex, these on its own will not be large enough to offset the external sector uncertainty. So 6.6, marginal upgrade, but we are not going back to 7% on a sustainable basis, which was your first question.
Understood. Anubhuti, is there anything in this data set that suggests that perhaps there are some signs that the economy may be overheating, becoming a victim of its own success? And if so, is there anything in this data set and perhaps in future quarterly GDP numbers that could bully inflation higher? Or are inflation expectations well anchored in your opinion?
I don't think, like a 1 quarter number of above 7% should raise any concerns about overheating. The economy is definitely not overheating, even though, a number just surprised us on the upside. And that is very, very well captured if you look at the core inflation number. Core inflation, which excludes your food and fuel, has actually printed below 4% for successive months, and only recently has gone up above 4%. And that is primarily driven by gold prices. Once we exclude, then core inflation is again below 4%. So there are absolutely no signs of overheating, whether we look at the internals of GDP data or whether we look at the inflation subcomponents. Most of the increase in inflation previous year was driven by food, and that is also coming lower. And inflation expectations are also very well anchored. That was one of the most important reasons why higher food prices since December 2019 never spilled into higher core inflation. So inflation expectations are well anchored, lower global commodity prices. growth, yes, close to trend, so no overheating, but there is underlying weakness when we are talking about household consumption. So no question about overheating at this point in time.
Understood. Thank you for that, Anubhuti, for that clarification. So, roll on RBI and June the 6th and the policy meeting. Does this number in any way shift market pricing and expectations surrounding an RBI move, a cut by 25 basis points?
As far as the June meeting is concerned, I don't think this release would really impact the expectations around the 25 basis points of rate cut. I think that's a consensus view. And as I mentioned, while the headline looks good, on an annual basis, there is a clear trend of moderation, and the underlyings are not as robust as the headline suggests. So it just doesn't impact the 25 basis points rate cut expectation on June 6th. Besides the June policy, our view is that in August, we are also likely to get another 25 basis points of rate cut, because it is important to offset as much as possible without creating inflationary pressures, the impact of uncertain external environment on India's growth. So we think another 50 basis points is given. Purely from markets expectation perspective, given that the Q4 numbers were very strong, I think market is likely to scale back its expectation about rate cuts beyond 50 basis points. And that scaling back would get reflected in the market pricing. And they would await more data releases to build in any more rate cuts beyond 50 basis points, which is our base case as of now.
Understood. But the leadership really like to highlight how India has now surpassed Japan as the fourth largest global economy. Is this symbolic at best when you consider that the outright goal of the Viksit Bharat policy to elevate India to developed nation status by 2047 requires sustained economic growth of 8% every year for at least a decade? And how achievable is this in the current policy context?
Sure. So, the first thing is that India has actually not overtaken Japan in terms of nominal GDP size, and it's primarily because yen has appreciated at a much faster pace than Indian rupee. So there is always this exchange rate element which we need to take into account. But it's just a question of timing because the nominal GDP growth in India is definitely much better than what we are seeing for other countries. And by end of this decade, our view is that India will turn into the third largest economy. As an economist, we like the absolute GDP comparison, but what we are more focused on is how it transitions itself or translates itself into per capita GDP. And India is still a lower middle income economy, $2,700. Maybe most probably by end of this year, India will turn from a lower middle income economy to an upper middle income economy, which is per capita income of greater than $4,000. So it's good, and it's definitely a milestone which needs to be celebrated, because at the start of this century, in 2000, India was not even in the top 10 in terms of absolute size. So there is a very, very credible journey which India has made. Having said that, to achieve 8% GDP growth on a sustained basis, which is needed to deliver on Viksit Bharat, India will have to undergo a lot of structural reforms. A lot has been done over the last decade in terms of infra spending. Digital revolution is a big catalyst in terms of efficiency improvement, but a lot more is needed in terms of physical infrastructure, education, skilling, health. So those structural changes are needed if we have to go towards an 8% growth.
Let me just pick up on the structural challenges, Anubhuti, especially job creation, particularly as it applies to recent graduates and the younger generation, the younger workforce. Are we witnessing what is essentially a decoupling of admittedly constructive headline GDP with job creation? We're not really seeing the quality jobs, are we, being created? That's what the youth have been saying in India. When is that going to happen, and what needs to be done to make it happen?
Sure. So if you look at, very right, if you look at the absolute number of jobs been created in India, that has actually picked up quite a bit post-COVID. India, if you go by the official data or the CLEMS data, India has been adding 10 to 12 million jobs, but almost, like 40% of the jobs are being created in the agricultural sector, where productivity is almost, 1/4 of what the overall productivity at the economy level is. So it has to be a multi-pronged approach when we are talking about job creation. The first challenge is that the number of people who are joining the labor force, the young labor force, they have to be employed in, and that would require skilling them at a very rapid pace. India's vocational training is in low single digits. If you compare it to other Asian economies, they have the percentage of labor force which has a vocational training is more than 40 to 50%. So skilling is the most important part. The second important part is that the ease of doing business in India needs to improve a lot. Again, a lot has been done over the last decade. There is no doubt about it. And India today is far better for doing business than what it was a decade back. But our competitors are Southeast Asian economies. And that competitiveness will come only when ease of doing business is implemented at a very accelerated pace. Yes. Land, labor, these are still Asian logistics costs are still lower than last 10 years before, but it is still higher. And unless these are done, the manufacturing base will not expand. And manufacturing is important if we are talking about job creation. And the last, the list can be really long, but again, investment in infrastructure, etc., will become extremely crucial in order to reduce the overall, yes. The cost which comes for the manufacturers who are setting up shops in India.
And especially the importance of crowding in private capex investment, which we have run out of time, Anubhuti, and maybe the next time we can talk about this and the entire Make in India platform as well in another occasion. Anubhuti, thank you very much indeed for your analysis. Anubhuti Sahey there from Standard Chartered Bank. We'll be right back in 2 minutes. Right, welcome back. Let's take a look at these Asian markets as we kick off the first trading day off the new month of June, and it is a risk-off start to the week for the APAC markets. President Trump said he would double tariffs on steel and aluminium imports, so that continued narrative about tariffs is making the market stumble around. The International Air Transport Association's AGM, meanwhile, is underway in New Delhi, and CNBC's Monica Petrelli has been speaking with the industry's top names, including the CEO of India's flag carrier. Monica, take it away.
That's right. Good morning, Sri. So it is the 81st AGM for IATA, but it's the second time that it has held this event here in India, the last time some 42 years ago. Now, if there's one topic that the industry would like to firmly put in the rearview mirror, that's the pandemic. But a lot of the problems that we saw start back in 2020 still plaguing the industry, namely a shortage of planes and parts. Now, when you add in geopolitics and tariffs, well, there is a lot to be discussed here today. Now, we were able to sit down with Air India CEO Campbell Wilson to talk to him about how his company weathering these challenges while ramping up for demand this year. Here's what he said.
Uncertainty is not helpful for business, but the underlying fundamentals of this market, of what we're trying to do, and the upside we see ahead of Air India is driving us forward, because we think there's massive opportunity yet to be realized.
And you did mention some issues with some neighbors. You know, the Pakistani airspace, Air India is saying it could cost up to $600 million a year. And you have appealed to the Indian government potentially for a subsidy. Do you anticipate that the airspace closure could last that long? And have you heard back from the government on that request?
Well, firstly, we haven't requested a subsidy. The fact is we were asked what is the estimate of what it will cost us should this be prolonged, and we provided it. Now, clearly, we would like to mitigate that cost in any way, shape or form that we can, and we're working on our own efforts to do so. But we simply don't know how long it's going to last. So we've had to optimize our business accordingly. We've been able to reinstate most of our operations to North America to non-stop, albeit taking some payload restriction in terms of the number of seats we can sell or the amount of cargo we can carry, but ensuring that we still have that non-stop product proposition. In a couple of cases, we need to do a short refueling stop en route. But for the most part, we've been able to continue operating as we had been previously, and we continue to be very nimble to adjust as the environment changes around us.
If this is to persist for many months in the future or even years, do you believe that the government may come in to provide some assistance?
Look, I don't know. We have close dialogue with government on many things. Time will tell.
One thing that we know, as you just mentioned, it is complicating Air India's efforts to move into that and increase the long-haul travel. How has that affected your strategy and your goals towards that?
We see such massive opportunity in this market. Domestically, India is the third largest air travel market in the world. It's growing at an annual growth rate of 8 to 10%. It has a propensity to travel 1/5 that of China today. So if Indians start traveling by air at the intensity of China, it's going to absolutely explode in volume. Internationally, Air India was the largest airline in the country, but only served 40+ international destinations. There are far smaller city-states that serve multiples of that. We're going to double our wide-body fleet from 70 to 150, and we think that that's just the start. India's economy, India's growth rate, India's population, India's diaspora, its increasing position in the global supply chain, and the fact that most people traveling from Europe to Australia, Asia to Africa, Middle East to Southeast Asia, they fly right over the top of India, so we can start playing in the international connectivity space as well. The opportunity in front of India is astonishing.
Now, no airline CEO has had an easy go in the past 5 years, but for Wilson, it said that he's had the Everest of corporate turnarounds on his hands. He took over an aging carrier from the Indian government back in 2021, last year seeing it through not one but 2 mergers. Here's what he had to say about where his priorities are this year.
Well, in the beginning, because we took over a business that had been under government ownership for a long time and had suffered from quite significant lack of investment, in the beginning it was about stabilizing the ship. Then it was about preparing for quite significant growth. We've gone from less than 100 operating aircraft to more than 300 operating aircraft in less than 3 years. Then it was about sufficiency, making sure that we were able to staff and operate that much larger fleet effectively. Now it's about efficiency, making sure that the business is operating consistently, tightly, ultimately profitably, and making sure that the experience that the customer faces is consistent. The other priority, of course, is the customer experience. I've talked about the need to refit the legacy aircraft, particularly the wide-body aircraft. That is well underway. As I say, the narrow-body fleet will finish that process by the end of this year. The wide-body fleet will commence in earnest in July, which is less than a month away. And then over the course of the next 24, 30 months or so, we'll complete that process. And so Air India will be operating at the world-class standard that we want it to be consistently.
And those, the refitting, as you just mentioned, those airplanes have already been rolling out on your major routes, is that correct?
So we ordered 470 aircraft, the largest aircraft order in history. We added another 100 aircraft to that order last year. We took a bunch of leased aircraft in on lease, or aircraft that had been produced for other airlines that they couldn't take, to do our initial growth spurt. But now we're waiting for those aircraft that are being manufactured specifically for us to roll off the production line, the first of which we received before the end of this year. In that first growth spurt came a bunch of Airbus A350 aircraft, which we've been able to fit out in Air India colours and Air India product proposition. And those aircraft are now serving Delhi to London Heathrow and Delhi to New York City. They're doing exceptionally well. The customer experience is exceptionally highly rated. And they are really an example today of the future Air India that will be ubiquitous in 2 years' time.
And, you know, you mentioned the order, the 570, 470 plus 100. That's bigger than a lot of airlines' entire fleet that you have on order. Is that enough, though, given the projections that you're seeing in the future?
Look, I think we'll be clearly ordering more aircraft, not just for replacement, but for growth. We need to digest those aircraft that we have ordered. There's a lot of them. We're building the infrastructure in order to do so, whether it be the systems, the processes, the maintenance facilities we're building from scratch in Bangalore, the staff training facilities. We've built South Asia's largest facility for training of crew, which sees 2,000 people go through a day. We've got 22 flight simulators in the process of being activated. So we're really building an ecosystem as much as we're building and transforming an airline.
Now, the AGM kicking off shortly, but security already tightening around us, and that's because of an appearance by Prime Minister Narendra Modi, who's set to address the association later today. It's back to you, Sri.
Great work, Monica. Thank you very much indeed for that. We'll bring you more big interviews after the break. We've got our conversation with Anil Chauhan, the Chief of Defence of India's Armed Forces. Inside India is right back. Welcome back. We are counting down to the market open in India. We are about 15 minutes away. This is how we are shaping up post blockbuster GDP for the fourth quarter, really surpassing expectations at 7.4%. GIFT Nifty futures 24,828.50 is implied indicated number, so we are looking at a lift of about 100 points. Dollar rupee exchange rate flat at 85.52. Now, turning to global and regional security narratives, the annual Shangri-La dialogue took place in Singapore over the weekend with French President Emmanuel Macron and US Secretary of State Peter Hegseth in attendance to discuss global defence. Lin, my colleague, was at the summit and had the chance to sit down with the Chief of Defence Staff for the Indian Armed Forces. Lin joins me now. What sort of messaging were you hearing? I mean, it's not just with the India-Pakistan conflict, but it's also increased defence spending, which has been enshrined in the national policy narrative in India.
Absolutely. I got a chance to sit down, as you say, with the general there, Anil Chauhan, and I was wondering, post that ceasefire, May 10, whether or not, or what the state of the communication levels were at between India and Pakistan, keeping in mind that both countries did send high-powered delegations to the dialogue. Let's take a listen to what he had to say.
Currently, I would say that we have an established mechanism to communicate with the Pakistan, and that's between the two militaries. We have a hotline message system. We communicate on almost, you can say, on a weekly basis. That's a scheduled call. In types of emergency, you can pick up the hotline and use it anytime. And this was the mechanism which was used to de-escalate this particular situation, which had occurred onto another border, on the western borders.
So is there any plans to meet at the dialogue at this stage?
No, certainly no.
Can you give us any other updates on the state of the situation at the moment?
Oh, yeah. So India's stand in this whole little crisis was always very clear that we had laid down limits of tolerance, and we had only hit terrorist camps. We never targeted any military infrastructure. We avoided civilian facilities, casualties, etc., and that was quite evident by the precision of our strikes. We wanted a dialogue with the Pakistanis. No sooner we had struck them, but they took their own time, and of course, once they made a request, we took our own time to respond to that. And in that case also, our position was clear that in case Pakistan targets military establishments in India, we're going to hit them back harder. And that's what we did, and I think better sense prevailed, and we spoke to each other and then de-escalated the things.
Away from that, I also asked him about the Quad security grouping as well, whether or not India would be open to potential cooperation with some of these countries in terms of defence manufacturing. Also keeping in mind as well that this is the year that India is due to host that Quad Leaders Summit at some stage as well. Let's take a watch.
Presently, we don't have much of a defence manufacturing relationship with Quad members, but certainly we would like to take that thing forward. We are in talks with countries like Japan. We have some kind of technologies which we are looking from them, unmanned technologies, underwater technologies. We are also looking at some kind of unicorn masks which Japan has promised us. But there is a long way to go. I've seen that all countries, including like Australia, they're going to increase their defense budget substantially, and I see a lot of prospects of developing equipment together, which is of common, where we can use it in a manner which suits both of us.
Can you outline how you see that strategy? Because at the core, I know it's about self-reliance, right? So is it a dual track process of focusing on self-reliance, but cooperating on things that, for example, are of that higher range or higher level of technology?
Yeah, so you see, for decades actually, India was dependent on foreign technologies. We used to buy equipment from abroad, complete platforms. But for the past, say, about 10 years or so, we are following a policy of what is known as Atmanirbharta, self-reliance in defense. And we've opened up private sector for defense manufacturing, and we're doing a lot of things to promote research and development in the field of defense manufacturing. It's part of that same campaign that we're also reaching out to our friends, nations with whom we have good relationship. We can do a lot of work on research and development. Means no nation will be able to do 100% of the things by their own. So that could be one. Joint research and development could be one. We are also looking at joint productions. That could be one. We are also looking at means Indian reforms actually have permitted now 100% defense investments in India, 100% FDI, foreign direct investment. So that means if you are a company outside, you can make things in India, then of course it's acceptable to India.
How are you looking at the Quad grouping in terms of the way forward here? Because of course India is focused on strategic autonomy as well. So how do you square that with the alliance itself going forward?
We have always considered Quad more of a security alliance rather than a military kind of an alliance. And there are a number of initiatives within Quad where security of nations could be enhanced. Logistic arrangements could be one. We could help each other with logistic supplies. Your supply chain management, etc., could be another. Information sharing is another area. Domain awareness, whether it is maritime, underwater, or air domain awareness. So these are some issues in which Quad countries can cooperate with each other, enhance security. We of course take part in a large number of military exercises. And yes, increase interoperability, etc. So that's also one segment of our Quad relationship.
Now, at the dialogue as well, Sri, we heard from the French President Emmanuel Macron. He actually gave that keynote where he really emphasized that France and by extension the EU is really looking to build coalitions with Asia as well, and that this emphasizing this concept of strategic autonomy, we shouldn't have to choose in the competition between US and China. And he specifically named India as a country that the French would like to deepen cooperation with. I also asked the General about that, and he said that, look, that relationship is multi-dimensional. On the defence front, we just heard about a few weeks ago another deal in terms of French Rafale fighter jets as well. But he was keen, again, the General Chauhan, to really emphasise the point here that we want to have agreements where there is technology transfer and domestic manufacturing as well, and that's something that the French are amenable to.
This is a very fascinating narrative, and it's an evolving narrative because defence is now enshrined as part of the Make in India policy. So you're hearing a lot about this, a lot of what General Chauhan was talking about being enshrined in the policy approach, and this is down to the indigenization of defence, self-reliance. He talked about that. And even I'm wondering if there was anything there about exporting that capability, because that's another emerging narrative. So the upshot of all of this, Lynn, as we've seen in Europe, is rearmament, and that is a major component of, let's face it, the economic growth narrative too, not least of all in India. Is that the impression that you got?
Absolutely. And I think, let me add on to that, one of the major takeaways, I think, particularly for markets as well, coming out of the Shangri-La dialogue is the messaging that came from the US and the defence chief, Pete Hegseth. One, he said, we remain committed in the region and focusing in as well on what he deems to be the key security threat here, which is China, and then imploring all Asian nations to spend a lot more when it comes to defence. He floated this number of 5%, which is the number that's being discussed as well in terms of the NATO grouping, and certainly they'll have a meeting in a couple of weeks to talk about that, keeping in mind that that's just a proposal at the moment. That is not policy even for NATO, but wanting Asian nations to step up in this regard. And, you know, I asked the General as well about defence spending and also about whether or not that's actually come up in the trade talks as well that's happening between US and India. And he said no. He said that 2% or around 2% is what we're really comfortable with unless there's some really major change in terms of the security dynamics. And he basically said, you know, this is our matter, that we cut our suit to our size.
Yes. But without a doubt, I do feel that defence is going to be a major component, as is energy, in any future US-India bilateral trade agreement. Great work, Lynn. Thank you very much indeed for bringing that interview with General Chauhan. Now, US President Trump laying his sights on steel and aluminium, doubling tariffs on those imports to 50%. We can see how this is playing out in the markets, and they are stumbling along in APAC. Starting this Wednesday, let's get more on the global ramifications of these tariff pressures on the trade deals that the US is negotiating. CNBC's Kari Njoji is in Japan with the details. Great to see you, Kari.
Thanks, Sri. There's a lot to unpack here, but shall we start with the trade negotiations? Round 4 is over, and the two sides, Akazawa-san and Besant, agreed that they're going to try to meet again before the G7. So that would be this week because the calendar is very tight. And then you have the Pittsburgh event, or close to Pittsburgh event at U.S. Steel, where President Trump came in, you know, music blaring, reminiscent of an election rally. And there off on the side came the vice chairman of Nippon Steel, Mr. Mori, to take the stage, sticking out like a sore thumb, but smiling as Donald Trump said that this is going to be a great investment. But at the end of the day, Sri, we don't know what the final form is going to be of this potential deal that has been in the works for close to 2 years. But the time is ticking away, because if they have to break it up, Nippon Steel will have to pay a lot of money. And in the face of these new tariffs, they're going to take place on the 4th. They're going to be enacted on the 4th. And of course, the day after that, the 5th, is what Nippon Steel says is the deadline for President Trump to make a decision on whether he's going to greenlight this deal based on the second round of recommendations from CFIUS. So there's a lot going on. It's part and parcel of everything. And it ties into what you were discussing earlier with Lynn about the defense strategy as well, because that possibly will come in as part of the negotiations.
You're quite right. A lot to unpack there. So ultimately, what do you think it's going to take from Nippon Steel's side to get this over the line, given all the national interest concerns that have come up and the security concerns that have come up in this narrative and discussion?
I mean, veto power seems to be the so-called golden ticket. And even if Nippon Steel succeeds in making this company a wholly owned subsidiary, which it has said all along that is the end game, and they're not going to budge on that, if they do cede final veto power to government or someone who's going to be sitting on the board, you have to wonder whether or not this is what Nippon Steel ultimately wants. There are quite a few number of mergers and acquisitions between U.S. and Japanese companies that have not panned out. I mean, they originally inked the deal, but Japanese companies ended up paying dearly for that. Nippon Steel really can't afford that. They're looking at net profits to decline nearly 50% this year. And we all know the pressures that the steel industry faces, not in the U.S. only, but here in Japan as well. So whether or not they're going to really grant this golden ticket, how much more investment they're going to have to make to possibly sweeten the steel. But as I say, June 18th, before then, they have to make a decision whether or not to go ahead or pull the plug, because otherwise they're going to be faced with more than millions of dollars in a breakup fee.
Kari, we'll leave it there. Thank you very much indeed for joining me. Now, we've got Access Middle East starting at the top of the next hour. Dan Murphy joins us now. What's on your radar this morning, Dan?
Hey there, Sri. Well, we are, of course, keeping a very close eye on what's happening with the price of oil right now after we saw OPEC Plus pushing through with a third consecutive production increase at the weekend. This latest decision is an additional 411,000 barrels a day starting next month. And of course, it comes amid already falling prices. And Sri, what's reported to be divisions within this alliance? Now, reports today suggest that Russia Oman and Algeria urged Saudi Arabia to hold output steady in July and basically wait to assess the impact of those earlier increases. Well, I've put the question to OPEC officials this morning who confirmed that, yes, a pause was part of the conversation, but this wasn't a resistance and output was ultimately increased anyway. So I'll be talking about this with Amrita Sen at Energy Aspects next hour. She's always great on the market, always great on explaining exactly what OPEC is doing. And of course, we'll get her take on the geopolitical considerations as well. Plenty of news flow around Iran, around Gaza, around Russia, and everything else as well, ultimately impacting market sentiment and direction right now too. So tune in for that conversation on Access Middle East. Sri?
Excellent, Dan. Thank you. Suffice to say, in the here and now, oil in the 60s is something of a sweet spot for India as a net importer. Thank you, Dan. Markets in India just coming online in Mumbai. We'll bring you a look at the early action there when we return in 2 minutes. Let's bring you up to speed with the Indian market open. The benchmark Nifty 50 going against the grain, interestingly enough, of what the futures were predicting, and that was a rise in the realm of about 100 points. We're down at the open by about 0.7%. So interesting how the market seemed to be sidelining for now. 7.4% Q4 GDP surpassing expectations, and instead seemed to be pressured by the broader narrative and the risk-off move in the APAC markets after President Trump said he would double tariffs on steel and aluminium imports. Let's give you dollar-rupee exchange rate, 85.4175, relatively flat at that level. Quick check on shares of Vodafone Idea. After the debt-ridden telco's quarterly loss narrowed, up by just a fractional amount. The board also approving a fundraising plan. However, Vodafone Idea has lost 1.6 million subscribers in the quarter. Remember, the company had recently warned that it may not be able to continue beyond the current financial year, without more support coming from the government. And we are counting down to 2 new listings in India today. Aegis Vopak Terminals, subsidiary of Aegis Logistics, will come to market with its downsized $300 million IPO. Grey market indicating a flat debut. And the one that's been generating a lot of buzz, Schloss Bangalore's IPO. The Brookfield-owned company runs the Leela chain of luxury hotels and priced its IPO at 435 rupees at the top end of the range to raise $409 million. IPO was 4.5 times oversubscribed, with the take-up higher among QIBs, qualified institutional buyers. But we could also see a relatively muted open going by the grey market. Let's get into this, and I'm delighted to say that Nikhil Shah is joining us now, Managing Director, Hospitality and Alternatives at Colliers India. Nikhil, welcome to Inside India. This is expected, as we said, to be a flat listing due to some investor concerns about valuation, significant debt burden, and operational challenges, including below average occupancy rates. Are these legitimate concerns? Should we manage our expectations, or is this a much longer-term play in the premium end of the market?
Well, thank you for having me on this show. As far as the Indian hospitality market is concerned, the stock market is doing well, and as far as the hospitality industry goes, it's riding the wave. From last 2 years, most of the companies are doing exceptionally well. Probably every quarters we are clocking the all-time high in terms of performance numbers. As far as the IPO goes, the market is right, the timing is right. Even if there are short-term any sort of a headwind, in the long term it's a great company. Schloss is a company which is owned by Brookfield, which is not only the asset owner but also the asset operator. In the luxury space, I don't see they have any competition. So I think from a long-term perspective, it's a very good story to have.
Right, but there do seem to be some disconnects, don't they, especially around valuation. Then why do you feel, Nikhil, that this issue perhaps is 7.5 times oversubscribed by qualified institutional investors, some of which have withdrawn from the broader market? What is that telling you about appetite and perception of this listing?
See, it's very difficult for me to comment on a very short-term perspective, if there is any sort of a step back in terms of, short-term this. But from a long-term perspective, it's still 100%. I mean, after dilution also, it will be 76% owned by Brookfield. As far as Indian market is concerned, even if you look at luxury market where ADRs hover around, 250 to 300 USD, we still have a headroom to do well. As far as Leela is concerned, it still only has 12 operating properties with 8 under pipeline. So I don't see any sort of a reason in long term not doing it.
Could it be then, Nikhil, that this is a bet on Brookfield asset management more than anything else, which is interesting because Brookfield itself is betting big on the India growth story and will triple its India investment to $100 billion within 5 years. Are you seeing it that way?
That may be one of the reasons for that. The other reason to see it, I'll answer as far as the hospitality industry is concerned. As far as India stands, we have around 200,000 keys branded inventory, which is much less than, if you look at any sort of a global locations. As far as the Indian growth story is concerned, right now we have, in terms of infrastructure elements, we have 150 airports, which have been doubled from last 10 years. If you look at 10 years further, it would double down from here. We will have 300 airports. If you look at current air fleet, the aviation, we may have close to around 700, 750. The current order pipeline is about 1.5 times. So yes. Looking at that, looking at, hospitality demand across all the segment, I don't see any reason why any hospitality company with any segment, be it luxury, be it leisure, be it any particular segment, not doing well.
Understood. And let's bring that in, Nikhil, the market segmentation, because Leela is firmly rooted in the premium luxury segment of the market. So would you say unaffected by this rise of affordable hospitality plays like Oyo, Bloom Rooms, Welcome Hotels, some of which are backed by some big global brands?
So as for, again, Indian hospitality industry is growing in all segments, be it luxury, be it business, be it MICE, be it experiential. As far as the luxury industry is concerned, because the capping is not there, it performs very well, in an upcycle market. As far as Leela is concerned, it's a very well recognized brand. Though it's an Indian brand, but in terms of foreigners also, they perceive it very well. So this would do well. As far as ITC, sure.
Yes, sorry, Nikhil, to interrupt you. We're running out of time, but I did want to ask you this. What are the opportunities and the challenges behind an expansion into Tier 2 and Tier 3 cities for a luxury brand like Leela?
So for a Leela, for them, in terms of expansion, they would probably go to more of a leisure location rather than going to a Tier 2, Tier 3 location, because leisure location would make much more sense for them, where in terms of affluent middle class, affluent Indians and high HNIs, can travel.
Nikhil, we're going to wrap it up there. So thank you very much indeed for joining me with your insights. Nikhil Shah there from Colliers, India. Thank you, sir. Right, that's all the time that we have today on Inside India. Do keep watching CNBC. Dan Murphy, you saw him earlier, is joining us next on Access Middle East. Have a good day.